Hi, I'm Hedgeye founder and CEO Keith McCullough. I'm excited to announce the Hedgeye on the Prize tournament. I challenge you to compete in this simulated investing tournament to win some serious money. We'll be awarding weekly and monthly cash prizes along with the big grand prizes. Along the way, we'll teach you how to take your investing to a whole new level. I hope you'll join us. I'll be coaching you every step of the way. I'm Keith McCullough, and welcome to day 2 of the Investing Summit. Thanks for joining us yesterday. We had a great audience and many great revelations, at least to me. That's what I'm trying to find, are the things that I, of course, don't know, or the process and perspective that may be different than what you hear from me on the macro show every single day. So one of my favorite strategists alongside Liz Ann Saunders yesterday, who we wrapped up with, is Jurrien Timmer. Welcome, the macro man from Boston.
Good morning. Nice to see you.
Yeah, good to see you. Well, you're not really from Boston, right?
I'm from. I'm a Dutchman from Aruba. Grew up in Aruba, so I'm a little bit of everything, I guess.
I love that. Actually, Eric Jurrien, who's running the TV channel here on the Switch, was just telling me an Austin Powers joke about the Dutch that an Irish guy at least laughed at.
Yes.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. I had the fortunate experience where we're starting to see clients again, institutional clients, and a couple of your colleagues, senior portfolio managers in Boston. We played golf a couple of weeks back, and they were singing your praises. So for those of you that don't know, Jurrien has got a lot of different hats, but in addition to being the head of global macro over there, a lot of people, internally, externally, are paying attention to his process. So I wanted to get into that because you and I can hopefully cover the waterfront here in, I guess, 35 minutes, and then we'll take some questions. But maybe just first opening volley, like wherever you want to go first in terms of where you think you're at that the street doesn't agree with.
I think the main question, as we all know, is whether inflation is going to be a structural phenomenon, because once you decide on that, everything else kind of follows along. The 60-40 paradigm follows whether bonds are negatively correlated to stocks, and that depends on inflation. And so I think that's one of the big ones to get right. The commodity space that I know you've been very focused on. Generally commodities are sort of collecting dust in a portfolio, earning the inflation rate, but with the vol of, let's say, small caps. But at certain regimes, like we're seeing right now, commodities do extremely well. So it's really a question of cyclical versus structural for me, and the 1940s to me continues to be an interesting analog. That was World War II, of course, but financial repression from the Fed, double-barreled fiscal monetary policy regime that really lasted for a number of years. And so I think it's kind of that macro secular backdrop that I think if we get that right, all the other pieces sort of fit. All the other pieces of the puzzle just kind of come together.
Yeah, commodity inflation, that's a real important one, I think, to people that pay attention to our process. The commodity cycle, you're starting to see longer term. I think Deutsche Bank just put it up today. They're showing like 25, 50, 100-year returns on commodities versus stocks. Like, I know that. They suck. They're terrible. But commodity cycles, which are much shorter than that, can generate a very high Sharpe ratio and a lot of alpha. Can you hit on that? Because you write quite often about Sharpe ratio, returns, reality. What is the score, whether you want to adjust it or not?
Yeah, exactly. So if we look, let's say 7 years from 1950 to present, and you kind of pull up risk versus reward, the annual vol on the horizontal, and actually we have the chart if you want to pull it up, slide 41. Annualized volatility on the horizontal, annualized return on the vertical. And we know kind of how this works, right? If you don't like any risk, you're in cash, bottom left. If you like lots of risk, you're going to be in small caps and emerging markets. And generally 60-40 is somewhere on the third towards from the left. And generally speaking, over the very long term, commodities as non-compounding assets, of course, are just kind of way out there, but just really at the inflation rate. But but if you go to the next slide, 42, you can see kind of that 1940s period, and commodities did very, very well. So it's a highly opportunistic asset class. You don't want to overstay your welcome, maybe not more than a couple of years or maybe even longer, but they don't compound, right? So it's very hard for them to beat equities over the long term. But it is easy for them to beat bonds when you have negative real rates and financial repression, which is what we had in the 40s and what we've had kind of so far this time. The Fed wants to taper, and it will taper, I'm guessing. But ultimately, I think the Fed is going to look a lot more like the Bank of Japan, has for the last so many years.
Yeah, that is a quick lesson that you succinctly put together with a lot in it. I mean, how awesome is that? But again, this is the point. For a long time, and I got to say, I'll admit it fully. I'm always worried about staying long commodities because I rarely stay long commodities for more than 2 to 3 years. So now I'm getting into year 2 and starting to think through what 2022 could look like. So I'm always concerned about my position, Jurrien, but that's one definitely. I think though that the people that are long the opposite of that, which you just pointed out, long-term treasuries, gold, which I'll go to plenty of times. I mean, those do not like rising inflation and rising real interest rates, do they?
No, and as we saw during the 40s, this is actually interesting. From 1942, when the U.S. entered World War II, till 46, we had a massive inflationary boom. Of course, the economy was mobilized to enter World War II. The Fed, which was not yet independent, was tasked with monetizing the increase in the wartime debt, which, debt to GDP went from 35% or so to 116%. The Fed's balance sheet went up tenfold during that period. People think QE was invented during the financial crisis. That it was invented much longer ago than that. And the Fed, held it capped long bonds at 2.5 and T-bills at 0.375%, and the Fed policy rate, which was the discount rate at the time, was about 1.5. And of course, inflation was running at 5-6%, even higher. But over that decade, it was about 6% or so. And so when you take the Barclays long-term government bond index, or you take the Ibbotson series, which predates the Barclays, but you take long-term government bonds during that period, they had an annualized return of 2.2 and an annualized volatility of 2.3. That's, so it's 3% percentage points below inflation. And so they were kind of dead money. And obviously that was like a tax on people because real rates were negative, and therefore bond investors lost purchasing power. Now, I don't know that it's going to repeat exactly the same way, but you look at the last 18 months, and actually we can pull up slide 2. You look at the last 18 months since the lockdown bottom in March of 2020 until now, guess who's at the bottom? It's long-term treasuries, and with a pretty sizable negative return against an inflation rate over that 18 months of about 3.6%. So we are following in that footsteps, and it'll be interesting to see, as the Fed now gets ready to taper, how long that will last and whether it will be a full taper, and then how long it will take for the Fed to get back into the scene, because the Fed thought it was done a couple of years ago, 2018. We were back above our star, and we had quantitative tightening. And a few years later, obviously unbeknownst and unpredictable by anyone, we had a pandemic, and we're right back to where we were then.
Well, let's get into, because I know you have thoughts on that, let's get into Fed policy after we just keep covering the bases here on commodities, volatility-adjusted returns. Like, these are, I put them in my framework, obviously, but when we have a regime, like an economic regime, like Quad 2, where you have both inflation and growth accelerating at the same time, that's really punishing, to things like gold and long-term bonds, for a lot of the reasons that you just pointed out. So if we are going into Quad 2, one, I think that I'm actually not consensus anymore. First of all, we had a Quad 3 slowdown, stagflation in the third quarter. That's when obviously the rate of change of growth goes delta negative. It went from 12% growth to 6 or something like that. My working view here is that what caused that, which is the Delta variant, at least part of it, is going to be the inverse of that. So we could get back to quad 2 in the fourth quarter. Today we saw the ISM services number, which is a September number. I'm thinking more of the October-November numbers when we're really seeing COVID case counts drop. They dropped another 23% this week versus last week. But do you agree with that or not? I get a lot of people that are like, no way. Earnings are going to be terrible. The economy's slowing. Fourth quarter GDP is going to be a bomb.
No, I agree with you. Actually, we could pull up slide 23. The way I look at the COVID numbers, and I'm no expert, but I look at the percentage of hospital beds in the U.S. occupied by COVID patients, and as you pointed out, clearly that wave has crested and is rolling over. So that's obviously great news. But superimposed on that chart, I show the Goldman Sachs effective lockdown index, which is their attempt to quantify how open or closed the economy is, and they have this series for most countries, but this is the U.S. one. And so, guess what? The economy is learning to cope with the pandemic by not closing down anymore when there's a wave, because you see that line, the lower that line is, the more open the economy is, or the less locked down it is.
Right.
So we didn't have to lock down, even though we had this very large wave, bigger than I was expecting. But I think the flip side of that is that now that the wave is cresting, we're not going to get that huge reopening dynamic that we had after the third wave. I mean, obviously we'll see improvement. People will travel even more, and they'll get out more. But like here in Boston, for instance, nobody shut down. Everybody was wearing masks, but they were still out there, and the city was booming, even though this Delta variant was raging. And so I don't know how much of a dividend there will be from the reopen, but we are at that interesting juxtaposition in the cycle. And actually, we can go to slide 18, where clearly the rate of growth, and you're a flow guy, the rate of growth in the forward estimates for earnings. So earnings are booming. They're 45% this year. There's no question about it. Q1 and Q2 were absolutely gangbusters. Q2's earnings year-over-year growth ended up at like 95%. But the forward estimate growth is clearly peaking, as it always does at some point, right? It's just the base effect runs out and the growth rate peaks. And so you were at that inflection point right now. And again, that doesn't mean earnings are going to fall. It just means they're going to grow less robustly than they did. And this is happening at exactly the time when the Fed is now going to be withdrawing liquidity. And
right.
Generally speaking, you get a little bit of a wobble in the market, which of course we're seeing right now. It's also September, October, the season that people like to worry. And so we're kind of in that little wobble zone. And actually, when you look at the internals of the market, we actually kind of started this wobble in April when we reached what I would call peak reopening. It's just you can't see it in the S&P because the large cap growers have sort of painted the tape, right? They just have made the tape go up. But internally, the market's kind of gone nowhere for 6 months, and that's fairly normal at this phase of the cycle. We're kind of in mid-cycle with some hints of late cycle. You talk about the quads, we kind of talk about early, mid, late cycle, but it's kind of a super condensed cycle where you have a little bit of everything happening at the same time.
Well, on that, I mean, like if you look at my my nowcast for GDP for slide 13, it's a lot of nothingness, Jurrien, which is interesting because if only because that's different. Typically you're going to get a cycle peak, then you roll off the cycle peak, and I'm on the back side of the cycle pretty quickly. In the USA, it was back as you recall back at the peak of the cycle in 2018. You subtly rolled over and then you rolled over a little faster, but the market definitely cares when you come off peak cycle. My whole point is if you go to the next. So again, GDP, I have a horse race between what it does in the third and the fourth quarter, but the street, like this Atlanta Fed number, largely reflects what happened in the third quarter. Go to the next slide, guys. Which now I'm running basically double the Atlanta Fed GDP nowcast. And there's upside to my numbers. So if we get more reopening, like just show slide 58, and like we have this, I dare you to show, you show me, I show you my slides. But don't overthink it. To me, it's COVID's down, service sector goes up again like it did this morning. We get some income acceleration, capacity gets unlocked, and probability of quad 2, particularly on the services economy, goes up without me having to see everybody drop off everything that's locked down in the ports of California. So that's a pretty interesting situation, right? Because all the reopening trades reopen again. I mean, you can look at an airline chart. It looks just like a chart of bond yields. You can look at a movie theater chart. You could look at a restaurant chart. And the restaurants, it's a different thing. But to me, the bond market and parts of the stock market are quite interested in the actual reopening.
No, absolutely. And, we've had a series of rotations, of course. Remember, into the pandemic bottom, and then following it was the big growers leading, and then we finally got that value rotation last fall, starting about August, and that ended earlier this year. And then we got this really big the divergence, right? Like the small growers, the non-profitable tech, the meme stocks, they all peaked earlier in the year, and then value kind of peaked in April, May. And I think we're seeing obviously a re-rotation now because, when rates are rising, the 10 years at 1.5 and maybe going to 2, who knows? That's going to be bad for the large growers because those are long duration growth stocks that are very sensitive to changes in the cost of capital in the discount rate. And it's interesting, actually, if we go to slide 13, you hear a lot of people talking about bubbles and the Fed has blown up bubbles and this and that. But very few people actually quantify it. And I believe if you can't quantify something, then just go away. But so in this chart, this is my cloud chart. It's a tips break-evens on the horizontal, nominal yields on the vertical, the 10-year yield. And that blue line is the regression of the two. And the size of the circles is the Fed's balance sheet. Mm-hmm. And what you can see is that based on where the tips break-evens are, and the tips break-evens may very well be wrong, by the way, at 2.25 over the next 5 years seems low to me. But but based on the tips markets, the 10-year nominal is about 100 basis points too low. So let's say it goes up 50 basis points to 2%. I think that's a fairly conservative guess. What does that do to the stock market? Well, go to the next slide. This is my favorite model, the discounted cash flow model. It's kind of 4-dimensional chess because there's too many variables. But if you look at the discount rate, so the rate at which we discount cash flows on the left, and we look at the earnings and the payout ratio on the horizontal at the top, and you just kind of eyeball those fair value PEs there in the matrix there, a 50 basis point increase in the discount rate is worth about 2-3 PE points. So that's 10-15% valuation. And when you look at slide 20, you can see kind of again that juxtaposition where we've had this massive increase in forward growth estimates. That is now peaking. Again, that doesn't mean earnings are going to fall, just grow less robustly. And when that happens, and the Fed is eyeing the exit, just like happened in 2010, when QE1 ended and earnings growth was peaking at exactly the same time, what happens is the PE starts to fall. Yeah. And so we're going to get maybe a 10-15% PE compression, which if earnings aren't growing is a 10-15% correction in the stock market. But when earnings are growing 10, 20, 30%, we may not even feel it. But it's, again, I'm describing that kind of that churn that happens at this phase. And I think we're going to be in that for a little bit longer, although we've already been in it for the last 6 months or so.
Yeah, we have a forward-looking, what we call micro-quad nowcast on earnings. So we do big nowcasts on growth and inflation, but when we take the micro-quad nowcast, clearly it came down. So we're using Wall Street revisions for that. And again, now it's stopped going down. So the delta on that is that if the Delta variant decells, we could get a reopening of earnings. Now again, if earnings go from, to your point, they go from up 100% year over year to up 30, but then they go from up 30 to up 40, now we're back inside of an acceleration. So that's, I think that at least what we're agreeing on is that the probability is there, and it's not a small probability. It's one that the bond market's paying attention to. And that's one point. The second one, before we go to the Fed points and tapering, because I think that's, I mean, again, of all the things I have to bloody well risk manage, that's one of the harder ones because I'm trying to predict, not their, insider trading, but their, their next move. But if you look at what you, back to commodities, it's a weird thing, and I trigger people when I say this, but I call Bitcoin a commodity. I just put it in my commodity box because it's got similar vol or volatility attributes in a shorter time series, of course, because it's not that old. But I've always put Bitcoin and crypto in the box, in my asset allocation box with commodities, because they have the same type of volatility attributes. What you have now, and I'm always smaller in those, Jurrien, because I volatility adjust my asset allocation. So I've always, my max position in coffee, for example, or oil for that matter, is always going to be 4% because of the volatility, historical vol. Oil vol can go to 300 when the oil price went negative, and you don't want to be long oil when that happens. But my question is, and it's weird because everyone's getting concerned about the stock market correcting 10, 12, 20%. And the things that are the riskiest on a vol-adjusted basis are losing their vol week by week, month by month, commodities and Bitcoin in particular.
Yeah, we're in a fascinating point in the cycle, and seeing the disparity or the divergence between gold and Bitcoin, which I kind of did my deep dive on Bitcoin about a year ago, and my conclusion was it is kind of like a more convex version of digital gold, I guess we can put it. But Bitcoin has been designed to be price inelastic, right? So it's like the volatility, people see it as a bug of the system, but I think it's actually a feature of the system because, with a commodity, if demand goes up, you have a supply response, and you don't have that in Bitcoin. I mean, maybe mining goes up a little bit, but still, you're going to have so many coins. Mm-hmm. And so it is going to remain inherently volatile, although over the years, probably it will become a little bit less so. But it's interesting, the Sharpe ratio of Bitcoin, and I don't think a lot of people appreciate this, is the same as a 60-40, S&P 500 Barclays Ag. It's about one and a quarter. It's the same Sharpe ratio as a 60-40, but the S&P is in a 20% drawdown, maybe a quarter of the time, and Bitcoin is in a 20% drawdown, like 80% of the time, but it's going up 200%. So you don't really notice it. But I think for me the lesson for Bitcoin is that a little goes a long way, right? So if you own it because you want to own a real asset, and I assume I see it as real estate and commodities and gold. It's a real asset that doesn't inflate itself out of existence. And if we're locking in, let's say, a 2% negative real rate by owning bonds, then you just need enough of Bitcoin or some other real asset to compensate against that. And for Bitcoin, that might only be 1 or 2% in a portfolio. You don't need a lot, and then you don't get hammered by the volatility, right? So like a 1% allocation of Bitcoin in a 60-40 only adds about a percentage point of volatility per year, and it doesn't increase your drawdowns because it's uncorrelated. It's not negatively correlated, but it's uncorrelated, and so it actually kind of works in that sense. But not if you own 20%. Then it's going to have a material impact, of course.
Well, that's the whole point about volatility adjusting your asset allocations. I mean, it's the vol, stupid. I mean, you and I get that, obviously, but again, when you look at it, like a day like yesterday, if I was running 60-40 with a blended U.S. equity book of that was overweight tech. I am overweight tech, so I'm getting bloodied over there. But I got a 4% position, my max asset allocation in Ethereum, and it's up the moon. So it's a very interesting, like you said, with lower sized bets offset if you're trying to smooth out. Not that I try to smooth vol, but again, be diversified.
Well, and I'll show you actually slide 49, I think is kind of a nice way of illustrating this. I mean, if we didn't care about vol, we would just be 100% long equities all the time because they are the absolutely proven compounder, right? I mean, it's like the eighth wonder of the world, right? Stocks only go up 60% of the time, but if you wait long enough, they're going to compound at 10, 11%. And if you do that long enough, your money is going to grow like nothing else can on the planet. Not bonds, not commodities, not real estate. But the challenge is that when you're in that 40% of the time that it goes against you, our fight or flight response is going to kick in, and we're just going to want to get the hell out. And that's where a diversified portfolio comes in handy. It is going to take return away, but it's going to keep you in the market when things get rough. So if we pull that chart up again, it's a little bit maybe hard, counterintuitive, but again, the 5-year CAGR on the horizontal, 5-year annualized return, the drawdown from a 5-year high on the vertical, The gray dots is S&P, the orange dots is 60-40. And you can just see when obviously the market goes down, you get into drawdown mode. That's the left-hand side of the chart. And you can just see there's a lot fewer orange dots than gray dots. And so to me, that diversification, whether it's from commodities or bonds or cash or crypto, it's about not getting into that severe tail where you're just not going to be able to stay in, and you're going to get out exactly at the wrong time. And then you have to try to get back in, and you've lost the compounding math when you're out of the market. And so to me, that's kind of always the gospel that I try to preach is, just get your portfolio right so that you can survive these drawdowns, because they're going to happen eventually.
Yeah, I mean, if you have, it's simple math. If I have a 10 to 20% asset allocation in Bitcoin and it goes down 50 to 80%, it doesn't matter what I did anywhere else. I've lost my money for the year and I'm not compounding anything. I mean, that's I think it's just a good reminder for people. That's helpful, very helpful, and educational at that. How about let's just flip a switch here to the Fed. The Fed. And by the way, the Fed. At least in the quad model is very instructive in terms of both what you just said and the Fed. Like those dots on the left side of your chart that you just showed, your drawdowns in equities and in Bitcoin are in the same quad 4. You just got to watch out for quad 4. That's the only place you can really lose money in Bitcoin or stocks. So it's pro-cyclical.
And by the way, that's why Bitcoin is kind of like a commodity, because it has similar left tail characteristics as equities do.
Right. So, so the opposite of quad 4 is quad 2. And we have a long history. I mean, again, I've back-tested every economic scenario against the quads. That's all we do, basically, right? And you've done a lot more than that. And thank you for showing people the breadth to your studies. I mean, you're like an encyclopedia rattling this stuff off. But quad 2, the Fed has tightened many times, never mind tapered in quad 2, and both stocks and both stocks and interest rates can go up at the same time.
Yes, I'm trying to look at my chart. Let's go to 12. So it's interesting, this is the fourth iteration of the Fed trying to exit, but that's kind of during this modern, post-GFC era where we're kind of locked in at low rates and the Fed's balance sheet is a very large factor. But to your point, 1994, right, the Greenspan era, I remember it because I was there. Greenspan doubled rates, out of nowhere. There was no dot plot back then. And that was a mid-cycle type of thing, which I presume is kind of like quad 2. And we've had other episodes of that as well. 2015, maybe that was not mid-cycle, but that was the EM kind of pressure. The Fed was trying to, the Yellen Fed was trying to lift off. And oftentimes, especially during secular bull markets, which I think we're in for equities, that is, these pressures, it flattens the slope of the market, of the S&P or whatever index you look at. And against a normally rising slope of 10%, a flat slope, is like a correction, but it's not a drawdown, right? So, so I think that's the distinction between what the secular context is for the market and during what phase of the cycle the Fed is actually tightening. Often it's during late cycle because the Fed is responding to inflation pressures which happen during late cycle. But right now we're kind of in this weird truncated cycle where we just went from early to mid, and now we have kind of this tight labor market and some inflation pressure. So it's a very weird cycle, one that's driven, I think, much more by policy these days. But to your question of the Fed, if we go to slide 10, this directly impacts interest rates. This is a chart of the 10-year yield daily chart. And so, we had the 1.9 trillion stimulus in March. That was paid for by the Treasury running down its cash balance at the Fed. So we didn't get the big issuance that you would normally get when you have large deficits being run. So the Fed's been running 120 billion a month. That's the blue line, and so it worked really well, and it allowed rates to stay low. But now we're presumably getting infrastructure followed by another 3+ trillion, depending on how this whole thing goes in Washington, and so we're going to get more supply because the cash is now gone at the Fed, and at the same time that the Fed is going to taper 15 billion a month, presumably, until it's at zero, at some point next year. And so you're going to get that supply-demand imbalance now that presumably should cause rates to rise from here, and you see technically, a nice little wedge breakout there already.
I like that. I like that. Those last two charts. First of all, I have the 10-year going towards 175 again if quad 2 hits. If quad 2 hits, again, it's back tested. To get a breakout in the long end of the curve, you have to have quad 2 economic conditions or a big nominal environment. And again, you're nodding because a lot of people are like, what is quad 2? But back to the chart that Jurrien showed before, which is a brilliant chart, the real rates in the Fed chart, where he's using Bloomberg data. You can see that back in 2013, 2017, those were the quad 2s. Yep. In 2017, just to give people, some people think this is all going to end because they always think it's going to end. I mean, that's kind of like zeroedge.com. But the fact of the matter is that, back in 2017, people say, well, it's just because you like Trump. It's like, what? No, it's not. It has nothing to do with that. We had pro-cyclical tax cuts back then, and it was super bullish for nominal growth. So I guess, the bear case is always like we have in South Korea. When a central bank tightens into quad 4, we don't have quad 4 in the U.S., so they're not tightening or tapering into quad 4. But the Fed did that in Q4 of 2018, and then they had the turn tail. So one, do you agree with that? Like you can tighten it could be a good thing, or it's fine, market's not going to care, or you can tighten it. You are the catalyst for very bad things that you're going to have to unwind here.
But either, I think the market has been conditioned. Understandably so, that it almost doesn't matter because they're going to win no matter what, right? So either the market wins because the Fed will tighten while economic and financial conditions allow that to happen, and then everything is good because earnings are growing and it's, kind of Goldilocks, do no harm, and we've seen that. 2017 was a good example of that. Or the Fed pushes too hard, like late 2018, as you just mentioned, and the market, has a fit. And, back then, we had a very violent 20% correction. And then immediately the Fed pivots, right? We had the Powell pivot in January 19. And that 20% was recovered, in a heartbeat. I mean, it was blazingly fast how quickly the market went back to new highs, which, by the way, is a very important characteristic of secular bull markets. And so, yes, one is a more nonlinear way of getting to new highs than the other. But I think the market assumes it's going to win either way. Either the Fed does no harm or it does harm and then has to pivot. And, and I think that's kind of the reality of the day. We're in a highly indebted economy. Inflation is running hot. Maybe it will continue to do that. I mean, some of it will be transitory, I'm sure, but other aspects are not. I mean, you look at the weight at the labor market; it's pretty incredible. Actually, page 25 shows you the ratio of unemployed to job openings fully back to the pre-pandemic starting point, and the quit rate from the JOLTS report is at 4 million people. And so, it's hard to see that not becoming somewhat inflationary on a structural basis. But the Fed's not going to be able to channel Paul Volcker, anytime soon. At 130, 140% debt to GDP, the economy could just simply not handle it. So I do think the Fed is going, we're going to have to live with probably slightly higher inflation. I'm not a huge inflationist because I think the demographics and the debt burden are essentially deflationary, but clearly we have some offsetting inflation that could end up being fairly sticky. And I think it just spells, negative real rates because nominal rates are only going to be able to rise so much in a highly levered economy. And you have 175, I have 2. I don't think they're going to go up much more than that. And if they do, the Fed's going to have to do what it did in the 1940s and start capping bond yields. And so I think in that scenario, you're going to see ongoing negative real yields, and that should be bullish for gold and any hard asset, of course.
Yeah, the hard part for a lot of people is that they were too intellectual about this. Like they had to make the big bang inflation forever call or not when, little old me, all you had to do is just stay long trending inflation until it's not. I mean, my landing spot on that, by the way, has got about 6 months left. So I agree with you. It's, if you guys look at our nowcast on slide 15, by Q2 of next year, it's almost mathematically impossible for inflation not to fall like somewhat significantly. I mean, 200-300 basis points against those base effects, but we'll have to see. I mean, that's the whole point about being data driven is I don't have to be an intellect. I just have to do what the numbers are actually doing.
But also, by definition, to exactly the point you just made, we're not really going to know if inflation is going to be structural until a number of years from now, right? Because you have these base effect cycles, right? Like mid 1960s, inflation was 1 to 2. It bumps up to 3, goes back to 2, then it goes to 4, then it goes to 3, and these base effects have to run off. But where you end up in terms of the level versus the flow, that informs you whether it's structural or not. And by definition, it's unknowable right now because we're still in that first bump that has to now come back as the base effect wears off.
Yeah, I don't think that answer is inconsistent with how you talk about the cycle, the stock market. Just apply it to inflation in the commodity market. It's just you get up, God willing, 2 feet on the floor, and you do your job, and then you'll have more information to make a better decision tomorrow. So thank you for that. Let's get, if you don't mind, I'm going to get into some of these questions that are in the queue. The first one, it's a good one because this is one I ask myself all the time. At least I think it's a very good one. And he's from Boston, so he gets the top votes here, Jurrien. Fred from Boston. Hi, Jurrien. Do you share Hedgeye's view on economic activity accelerating in Q4, or what could slow down the economic activity? Where could they be wrong?
I think the economy is strong. It's going to remain strong. I think that the risk to the economy normally you would think about demand side factors as a risk. People they want to buy fewer things, so then companies respond by dropping their inventory. We may have the opposite side. We're really dealing with the supply side of the economy now with these bottlenecks and these supply chain disruptions. And you see what's happening in China. What is it? 160 ships outside of the LA port. They literally just do not have enough people to unload the ships. And now you're hearing stories about large retailers like Nike, for instance. They may have to start air freighting their sneakers in from Vietnam or China, wherever they're made. Air freighting. So the supply chain bottlenecks could actually slow things down just because things are not being delivered. And of course, one of the questions, coming from China is with the property sector. I don't think it's going to be systemic because I think the Chinese government has certainly the resources and the willingness to ring fence that sector, maybe at the expense of Western bondholders, but that's a different story. So I think the economy is going to remain robust. People are flush with cash still from the fiscal stimulus and just from the ongoing recovery since the pandemic. But I do think that maybe that dividend that we got used to after the third wave of the Delta of COVID, we weren't not going to see that same dividend because the economy never really had to lock down during the Delta variant. So we're going to get less of the other side of that. But I think overall, with the Fed in do no harm mode and rates still at super, super low levels, of course, and real rates at negative levels, and the job market being very robust, I think the economy is going to be fine.
Well, there are still 2 pretty big dividends. I mean, what you just said, 160 ships going to 106 ships. I mean, that inventory is a dividend. I mean, guys on slide 54, I mean, you and I will never see this chart. Like, macro men on our watch will never see inventories like a ball underwater like that ever. To me, that's a dividend. I mean, that's the dividend that we don't know, when it's going to go from 160 to 157 ships but again, this is still America. I think people have a self-interest to get this stuff off the boats and sell to people.
Absolutely. It's just that they just, it's just a bottleneck. They're unloading twice as many ships a day as they normally do. I think it's 16 versus 10. But it's just, these supply chain bottlenecks will get resolved. But maybe do your Christmas shopping early this year.
Yeah, well, actually, I'm a hockey guy, and you got to buy all the sticks you can because you're not going to be able to get them anymore. But yeah, these kinds of things. It's in a perverse way. Like the more bearish you are on bottlenecks. And by the way, let's just be clear, Jurrien. It's on the cover of Barron's. I mean, yeah. Okay. Barron's is kind enough to cite Jurrien all the time, and actually they even cited me lately, which may be a sign of something. But I mean, everyone knows.
Yeah, it will get resolved, but it's going to be inflationary, right? If Nike is air freighting their sneakers over rather than putting them on a container ship, you're going to be paying more for those sneakers. But people have the resources, they have the income to do it. But it's so price is always the is always there to clear supply and demand. And the demand is there, the supply is restrained, and that means price is going up, and that's exactly, of course, what's happening.
And people have the cash. I mean, that's the other thing. It's a huge dividend. Look at that slide 53 where we show U.S. bank deposits. I'm sure you have a chart that this is just our color coding, not yours. But again, you add that money market deposits. I mean, $4 trillion. I mean, they're going to be able to buy the running shoes. There's no problem with that. Or the trucks, the Ford 150s. Like we talk a lot about the pent up demand. It's not that people don't want trucks and shoes. It's that they can't get them. So if you're a short, I mean, I'm a professional short seller. I know you got to have a catalyst. If that catalyst reverses on you, it might look a little bit more like today's stock market as opposed to yesterday's. But it's going to be a good bull bear debate. And if I'm right, I'm right. If I'm wrong, I'm wrong. And the same thing with you. Dave in California asking more about, he wants to know if you had a level you think bond yields are going on. And more importantly, do you think that the Fed will, if they go to 2, I think you said 2, right? Jurrien on the 10?
Yes.
Do you think that the Fed will just let that go or agree with it and tighten into that? Or how do you think that the level matters to them?
It depends on why rates are rising, right? So if they're rising because inflation expectations are going up, then the Fed doesn't care. If they're rising because real rates are rising, then they're going to care. Not to 2%, but if they went to 3%, all based on rising real rates, that would have a significant impact on the economy. So it's always about the real versus the nominal. And actually, if we go to page 11, I have a very simple bond model just based on 10-year CAGR in nominal GDP and the Fed funds curve. Mm-hmm. And you see that band there. It's kind of 1 to 2%. We're at 1.5%. And so that's been a pretty good guide. It's obviously a moving target because as the Fed funds futures curve changes, those bands change as well. But I think 2% is a reasonable number. If it goes much higher, it's going to have an impact on the economy, and the Fed's going to get worried, and maybe it starts to back off. So I think that so 1.5 to 2 is not the end of the world. It's maybe a 15% haircut in the PE ratio for the S&P. But again, as we were saying, if earnings are growing, that doesn't mean that's coming at the expense of price. It just means that the market will be more flat instead of upward trending for a little bit.
Yeah, again, it's like if you have a crystal ball and you know what the next quad is, then you know what to do with that. Like 2013, 2017, it went to the top end of his band. I mean, that's the whole point. And I'm actually just using prior resistance at 175. You could definitely to the point of that chart, you can get to 2.25, 2.5. I mean, obviously, the faster you go there, the more people have some issues with that. Question quickly. This is a really good question. I do not know what the answer is to this. Addison asking this question: is the spike in the repo market, SRF, et cetera, a deeper trend of a longer-term inflation spike, aka need to inject the market with more liquidity other than QE?
I think it's just a plumbing issue. And again, going back to the earlier chart 10, the Fed's buying a lot of bonds. They're stuffing the banks full of excess reserves. The banks don't know what to do with them, so they go into the repo market. At the same time, the Treasury, rather than issuing bonds to pay for its fiscal programs, it was running down what's called the TGA, the Treasury General Account. So the Treasury had all this cash, over $1 trillion, sitting at the Fed. That was basically the gains from the Fed's QE. That accrues to the Treasury. So between the Treasury running down its cash balance and then the Fed stuffing the commercial banks full of reserves, there's just, it was just too much money looking for a home. And normally they would buy bills, but if the bills are not getting issued because the Treasury is running down the cash balance, you get this kind of big plumbing problem. And it just shows you that there's a limit to how much QE the Fed can do, especially when the Treasury is not issuing debt, which is a temporary issue, right? Because the next fiscal will come from new issuance. So I don't think it's anything more than just the plumbing of a system that is stuffed full of extra money, and that needs to go somewhere. So it's a plumbing feature and not some systemic issue of something that's going wrong, I think.
Yeah, that plumbing issues are really important to talk about because these are often used as fear-mongering charts on certain websites because that's how they get paid, clickbait, et cetera. I'm going to have Mike Green on later, and he's definitely a guy to ask on the plumbing of it all. But if you actually just look at what I would like, if I look at our systemic risk monitor, which includes things like the TED spread, Euribor OIS spread, CDOR versus the same, high yield spreads, they literally didn't move yesterday. Like not a basis point. What do you think about that relative to the modern era of what I'll just affectionately call and salute as macro tourism?
I agree. It shows you that there is not a lot of systemic risk in the market. Credit spreads completely yawning. The S&P's down a whopping 5-6%, which, by the way, is completely a rounding error in the grand scheme of things. But there's no signal from the credit markets. The system is completely flush with liquidity. And as you know, a crisis usually is coming from a lack of liquidity. Think about the financial crisis. That was a liquidity crisis. It was a balance sheet crisis and a default crisis, but it was mostly a liquidity issue, and that is not an issue right now. The only place I could think of where maybe something would happen is, again, in China with the property sector, where companies are now missing bond payments. But again, my sense is that the Chinese government, which of course, pulls all the strings over there, will just have the banks ring fence it, and then the only ones that really get punished are the Western bondholders, which is already happening.
Yeah, I'm gonna have Kyle Bass on tomorrow. We're gonna talk a lot about that. But again, I look at what the market's doing. If I look at the Chinese interbank rate, which is another way to look at everything that I just said, it literally didn't move a basis point yesterday. In the last month, which includes all of what happened so far at Evergrande, is like an 11 basis points. So again, I think our job is to ask the questions, ask the right people, and get a well-rounded view. But at least to me, I always say, if you're bearish on China, just short China. We're short China. It's fine. It's easy to do. That's what
and by the way, we have like the flip side of what we normally have, right? Over the last 20 years, when the economy would have a problem like the GFC, China would be the one to reflate out of it. Yeah. And that would get commodity prices going. It would get foreign exchange reserves going, trade going. This cycle, it's been the other way around. It's been the U.S. that has brought out the big bazooka with that fiscal monetary 1-2 punch. And so it's interesting how the shoe is on the other foot now, where it's been the U.S. being that marginal stimulator of the global economy.
Yeah, that is. And by the way, that's a great summary to all of it. And again, maybe alleviating some of the concerns. And again, people are triggered by a lot of different things that they're, again, being encouraged to click on. I'd encourage you to do more of what Jurrien just did, which was he just provided you with like an awesome 45-minute education. Thank you for that. Like all these slides, you just set a record for popping up your own content on Hedgeye TV. So nice job. Thanks, man.
My pleasure. I got 50 more, but we'll save them for next time.
For next time. Thank you very much. We appreciate it. Unfortunately, we're out of time with Jurrien. But again, do you have a process? Do you have the time series of data? Are we talking mathematically? Are we talking emotionally, politically? I got to go eat some lunch. I'll be back. Thanks.